A lot of lenders have withdrawn their products from the market.
The government can't afford for the property market to go off the boil.
The average 2-year mortgage rate up to 6%.
Everyone's freaking out like it's the end of the world.
We're encouraging buy-to-let landlords to act now.
Jeez. So all the people, interest rates are going to go up. They should have been buying.
The Bank of England have raised interest rates to the highest level since 2008.
We've already seen some landlords looking at their portfolio and selling them.
We know that whenever there's a crisis, there's always opportunities to make money.
Think of people who bought properties 20 years ago and then suddenly the slump came and they found it was in negative equity. It's double in price now.
What do you think is going to happen with interest rates over the next 6-12 months? Welcome back to my channel. I'm sat here with Andrew Clothier from Regents Court Financial. He is a mortgage broker, finance expert, and we're going to be talking all about interest rates. What the heck is happening right now with mortgage rates and mortgage lenders withdrawing their products from the market? What's happening? Can you still get a mortgage? Is property investing dead? Is it still viable? And Andrew, I really appreciate you coming all the way from Wolverhampton.
No problem.
So firstly, what is happening with mortgages?
Before the big problem that cropped up 2 or 3 weeks ago, several mortgage lenders had closed their door to new business only so that they could get through their pipeline because they were inundated with work.
Yeah.
But then as soon as it hit us a couple of weeks ago, then a lot of other lenders followed suit, not only to clear their pipeline, but to work out over the passage of time how much they would in future charge people for a mortgage.
So what's the reason that a lot of lenders have withdrawn their products from the market? Are they coming back, and when?
They're started to drift back now, one or
Right.
two. So they will gradually, all of them, drift back over the passage of time. How quickly, we don't know. But it's not fair to say you can't get a mortgage at the moment. You can get a mortgage, but the number of lenders you have to choose from is quite severely restricted.
Right.
So if you don't have to get a mortgage now, if you can wait a little, then it's a good idea to keep an eye on what's going on, so you can see gradually as more and more lenders open their doors.
And we predicted this would happen.
Yes.
I mean, we've done interviews before.
Yes.
We predicted this would happen. Interest rates have historically been extremely low.
Yes.
The fact that they've gone up a little bit, everyone's freaking out like it's the end of the world. It's really not. I mean, we were talking earlier about how the banks even stress measured this.
Yes.
Talk to me about that.
Yes, buy-to-let mortgages, for quite a few years now, when somebody wants a buy-to-let mortgage, if, for example, they want to borrow £100,000, they usually have an interest-only mortgage. So before the bank grants the mortgage, they stress test the rent against the interest payment. And the interest payment they used generally was 5.5%.
Right, which is close to what we are right now.
It is. So in other words, when people were only paying 1.5% for an interest-only buy-to-let mortgage, the case was being stress tested at 5.5%, which seems severe in some cases. But if you think about it, it works well for the borrower as well, because not only does it prepare them for the event that interest rates get to 5.5%, it also tells them whether or not the buy-to-let is a good prospect. In other words, if it doesn't get anywhere near the 5.5% threshold, then it may be a signal to the buyer that perhaps they shouldn't be buying this because there's not enough in it for them, the gap between the rent and the mortgage payment.
What do you think is going to happen with interest rates over the next 6-12 months?
I honestly think that interest rates will probably continue to rise to some extent. Everybody's getting excited about next week when the Bank of England make their announcement again, and all the media are forecasting that the rate will go up again. At some stage, you and I know that it will have to settle back because it'll stop people buying properties.
Yeah.
And the government can't afford for the property market to go off the boil too much. They've got to keep the market as balanced as they can, the government.
Yeah. Well, I mean, I've been in the game for a long time, not as long as yourself. I mean, you're now, how old? 73? 73.
Yes.
But I mean, you've been through the 80s where rates were at one point just close to 15%, right?
Yes, yes.
I've been through at least 2 recessions, and we know that whenever there's a crisis or whenever there's a big change, actually there's always opportunities there. There's always opportunities to make money. There's always opportunities to adapt and profit off of the crisis, off of the change.
Yes, I mean, there's no question that for some time the mortgage lenders have thought that the value of properties will go down, because we had a tremendous boom this year, haven't we, with people being gazumped and prices pushed up. Lenders have all thought for some time that won't be sustained, and they're right. We can't sustain that level of increase. It will ultimately level out, and then it will probably shrink back a little bit. For a good year now, mortgage lenders' valuers have been often undervaluing the properties less than the purchase price. So if you've agreed to buy somewhere for 100,000, it's been quite common for them to value it at 95 or 90,000.
Yeah.
That is a marker that the lenders themselves have forecasted that there's going to be what they call a correction.
Right, and there's a big difference as well, Andrew, between a property crash and a property correction or a property dip.
Yes.
You know, people are talking on YouTube, I see all the time saying, they've been saying it for years, there's going to be a crash, there's going to be a crash. Properties always go up and then they dip, and then they go up and then they dip, and that's the way the market works.
In my experience, politicians have always said, if we get into power, we'll stop this boom and bust in the property market. And I always say, how are they going to do that? That would take quite a bit of doing.
Yeah.
And so I don't think there's going to be much movement in the property market in the immediate future. I think there'll be a levelling out. Years ago, we didn't have the buy-to-let market. The first buy-to-let mortgage I did was in 1997 with Skipton Building Society. They were the first lender to come out with buy-to-lets. Other lenders said, oh no, not buy-to-let. So up to that time, first-time buyers drove the property market. If you couldn't get first-time buyers to buy houses because they were priced out of the market, you had no property market. Since then, first-time buyers are generally in competition with the buy-to-letters. So that has meant that the market has always been a little bit more buoyant than it would have been if we didn't have the buy-to-lets.
Interesting. Another thing as well that I see at the moment is with interest rates going up, and with property prices potentially dipping, I think that's going to lead to quite a lot of landlords being in negative equity.
Yes, we've already seen some landlords looking at their portfolio, identifying some of the weak spots and selling them. And I think there'll be more of that. The other thing that's coming up, which a lot of landlords I speak to don't seem to understand, is that the EPC certificate that you have on your property, after 2025, if you rent your house out to somebody, it'll have to be at least an A, B or C EPC certificate.
That's April 2025, I believe.
Yes, that's right. So it's not far off.
No, it's not.
And what will actually happen if we're not careful is a landlord will approach somebody like us and say, in April or May 2025, oh, I've got a portfolio of properties that are all below a C. Can you remortgage them, please, so that I can produce some cash to insulate them and bring them in line? And will the lenders remortgage a property after that time that is not an A, B or C? Or will they say, no, get it up to scratch and then we'll give you the money? So we're encouraging buy-to-let portfolio landlords to act now.
Yeah.
Rather than wait till the last minute.
Well, one of the things that we've seen being opportunistic in our business is we've been securing more lease option agreements than ever before.
Yes.
Because there's landlords that are wanting to sell.
Yes.
Some of them are financed up to the hilt.
Yes.
So we can say, look, we'll buy your property off you. You want to get rid of it. You're worried about EPC and you're worried about, we'll take the property off you and then we'll buy it off you in 7 years. And then we're taking over their mortgage payments. But of course, then we're using our strategies with mortgage consent, of course, like serviced accommodation, HMOs, room lets, getting a nice cash flow from the property. And then we're getting the option to buy it.
As you say, whatever happens in the market, there are opportunities for people.
What about the media? Because the media are absolute scoundrels, in my opinion, in terms of continually scaremongering, continually publishing sensationalist stories just for views, and information that's not even true. And I've seen so much stuff about, even on the TV and in the newspapers, about mortgages, about interest rates, that frankly, I wish that you'd been there in the room to argue. Because, I mean, there was one lady saying, oh, my lender has just pulled out and now saying that I have to pay 10% and this, that and the other. And I'm thinking, that doesn't make any sense.
No. The media are bound to pick on the interesting looking cases. The main misconception people have is that if they already have a mortgage offer, so if the lender has issued them with a mortgage offer and they're just waiting for the legal work to complete the deal, it's very unlikely that the mortgage lender will either increase the interest rate or remove the mortgage offer. It's possible, but it's unlikely, and we haven't seen it. And in fact, I noticed that Leeds Building Society have emailed lots of their customers who have a mortgage offer at the moment and are waiting for it to complete, waiting to buy the house or to remortgage it. And they've sent them a very nice email saying, just so that you understand, we have no intention of removing the terms we've issued to you, even though interest rates have gone up. As long as you complete on the mortgage within the time constraints of the mortgage offer, then we're not going to withdraw. And I think I haven't seen one withdraw it, and I think it's unlikely it's going to happen.
We were working awfully hard on my portfolio in the last year or so, right?
Yes, yes.
And I've managed to get millions of pounds of finance, all fixed,
Yes.
on ridiculously low rate. I mean, my personal house, which is a bit different, I think is about 1.8%.
Yes, yes.
Which is crazy. £2 million mortgage.
Wouldn't you could sell that mortgage on eBay?
Yeah. But then also my whole portfolio and my buy-to-lets. I mean, I don't want you to get into trouble and have everyone bombard you, because I know I did this a couple months ago. But what did we fix them at? Like 3.3%?
Yes, yes.
For 5 years?
Yes, yes.
And you've been able to fix rates on some mortgages 10 years?
Yes. We've got one man who buys buy-to-lets, and if possible, he always asks us for a 10-year fixed.
And what has he been paying for that? Like 5 or 6%?
Not as much as that, no.
What's he been paying?
3 point something or maybe 4%.
Jeez. So all the people, right, a year ago that were saying, oh, interest rates are going to go up, I'm not going to buy because I'm scared, they should have been buying and fixing.
I'm a firm believer that if you keep putting off buying a property because you're not earning enough or you haven't got a big enough deposit, you may not end up getting a good advantage. And if you buy a property, if you intend to keep it, if it does reduce in value slightly, as long as you're not selling it, you haven't lost anything.
Right.
And think of people who bought properties 20 years ago and then suddenly the slump came and they found it was in negative equity. It's double in price now.
Exactly. You've got to get into property for the long game. You can't be thinking about the next 3 months.
Definitely.
And what are prices going to do in 6 months? What are interest rates? You've got to think long term.
Yes.
Talk to me a bit about what people are doing at the moment that haven't got money, that are wanting to buy properties.
One of the things that we've noticed recently people are doing, especially younger people, their parents often will step in to help them, either by gifting them a deposit, or if the parents haven't got it, quite a few of them have been remortgaging their houses, even if they're too old to get a conventional mortgage. So people over 55 can have what's called an equity release mortgage, and that's where they're not tested to see if they can afford any repayments because they don't have to make a repayment. It's called a lifetime mortgage, and the idea is that unlike most conventional mortgages where you have to make a mortgage payment every month and you have to specify the end date, you don't have to make a mortgage payment. It's voluntary. And the end date is not to a fixed term. It's to when you, if you're married, you and your partner either die and the property becomes empty, or if you go into a home.
So how do you qualify for this? So if you're over 55,
Yes.
because most people that are over 55 start thinking, I'm not going to be able to get a mortgage because I'm not earning enough, I'm not qualified, but you're saying that that's not necessarily the case.
No, I mean, we do plenty of these where there's no requirement for them to make any payments of interest or capital. So the lender doesn't assess their ability to make any payments, because the lender knows that if they can't afford to make any payments, the interest just gets added on to the mortgage every year until the property becomes empty.
And how much can they normally pull out? So let's say they've got a property that's worth £300,000 and it's got no mortgage on it, how much would they be able to release?
It's entirely based on their age. It's a bit morbid. So if they're only 55 and they're female, they might only be able to get 25% of the value of the property out. So it's based on morbidity. So in other words, what the lender does is they look at the age and the state of health and the gender of the person now,
Yeah.
and they work out how long the mortgage is likely to be outstanding. If you're 80, the chances are it's not going to be outstanding for more than about 20 years. If you're 55, it could be outstanding for many years. So the interest, if you're 55, would add up a lot.
Why don't more people know about this? Because so many people say to me, oh, I'm 67, I've got a house, I own it outright, but there's no way I'm going to be able to refinance it because of my age.
I think a reason why a lot of people don't know about it is they have heard of it, but years ago this type of mortgage was very inflexible and had a bad reputation. So many people I meet who ask me for one of these say, well, I'd like to talk about it, but I've heard from everybody, don't touch them, they're bad news. Well, that might have been the case 20 or 30 years ago, but now there are lots of hybrid cases and they're so popular that lenders are very flexible and offer a very flexible approach.
People sometimes lose so much money because they just don't know they're able to do something.
No, it's quite true, because I've got a couple at the moment and they've got 2 daughters and their daughters want to get in the property market. So they're refinancing their house and giving the daughters 80,000 each, and the daughters are buying houses now, rather than if the parents live another 10, 20 years, the daughters don't have to rent for that period.
And ultimately, when it comes to interest rates, because now, what are you talking right now, if you were to get a buy-to-let property, interest rates, I know it would depend on different factors,
yes,
but it was a year or two ago, I used to say around 3%.
Yes.
Now, what are we talking, more like maybe 4 to 5, 4.5?
Closer to 5.
So a decent rate now, what someone should be happy with, would be about 4.5 to 5.
Be fabulous, yeah. If they can get that would be a good rate. Some people are getting those on the existing mortgage they have being transferred to a new scheme. So we did a couple yesterday where they were paying, I think, 4.3 or 4.4. But that's not a new mortgage. That's where your existing mortgage scheme ends, and we go back to the existing lender and say, okay, they want to stay with you, say for another 2, 3 or 5 years. What can you offer them?
Yeah.
And that's called a product transfer. There is another solution that we're working with some people on, if I may mention, to the high fixed rates of interest. It doesn't suit everybody, but we've done a couple in the last few days where the interest rate is lower than 4%, sometimes as low as early 3s, 3.2, 3.5. Their tracker rates, which everybody throws up their arms in horror, in other words, it's tracking the Bank of England base rate. So if the Bank of England base rate rises, your mortgage payment rises. But there are no early repayment charges with them.
Great.
So if you're somebody who says, well, okay, if I have a tracker rate at 3.5, instead of paying 5.5 fixed, that's a 2% reduction in what I would be paying. Do I think the bank rate will continue to rise by another 2%? We don't know, do we? But it's a bit of speculation. But if it does continue to rise, you can get out of it because there's no early repayment charges on the mortgage.
So how much would your interest rates be then on a tracker right now?
What we did on Friday for somebody was an existing client having a new mortgage deal with the same lender. That was 3%.
3%?
On a tracker rate. They paid a 995 fee for it.
That's peanuts. So they're paying 3%. That's less than me. I know it's not fixed, but still, as you say, that probably is the thing to do, right? If
the media are right that in November interest rates will rise again,
then you refinance, and there's no early repayment fees.
Not everybody wants those. Some people are balancing and saying, I'm more comfortable to know that I'm fixed, and I understand that.
Yeah.
But some people are saying, well, as long as I don't have any early repayment charges,
I can always change it.
I can change it. Now, some trackers come with early repayment charges, so that's a different kettle of fish.
Yeah. Andrew, so many people used to come to me all the time and they used to say, I've got a right to buy on my house. It's a council house, whatever. It's worth 500 grand. I can buy it for 300 grand. But they didn't think they could buy it, Andrew, because they didn't have the deposit.
No.
But then you came along in your shining armour and helped all these folks out. And I want to give you credit for that because there've been so many people, I'm sure you've been bombarded with calls, that have now bought their house. How have you been doing that and how does it work?
Right, well, the first thing to say is this. The market value you said was 500, they can get it for 300. So they're getting £200,000 discount.
Right.
So they're buying a house worth 500,000 for 300,000. Most lenders who do right to buy mortgages will say you don't need to put a deposit down because you've got the difference between the 300 and the 500 market value as your deposit.
So what do you do, not right to buy, just generally speaking, if you want to buy a house, maybe you want to live in it, maybe you want to buy it and rent it out, but you really want to buy a house, you've got the deposit.
Yes.
But you can't get a mortgage because maybe you've got bad credit or maybe you don't earn enough money or for whatever reason, no lender will touch you with a barge pole.
If it's because you don't earn enough money, you can introduce a guarantor to the prospect, or you could have somebody join you on the mortgage as a joint borrower if their income is sufficient.
But if they join you on the mortgage, they don't own the house.
You've got two options. They can own the house, and if they do, you can agree with them what share of the house they own.
1%.
Right, that's fine. Of course, they need to understand, and we would always explain to them, if you have a joint mortgage in this country, never mind who owns what percentage of the property, each borrower is responsible for 100% of the mortgage. Mm-hmm. So because you only own 1% of the property, it doesn't mean you're only responsible for 1% of the mortgage.
So you need to get somebody on that was basically doing you a favour.
Yes.
And understood that, look, I'm only getting you on this house or on this mortgage because I can't do it myself. So it would need to be a friend, it would need to be a relative, or a parent, or someone that was doing it. And that's what my stepdad did for me.
Right. Well, quite often when we do that, we have a 2-year fixed or something, because the person who needs the help from somebody else because their income isn't enough knows that within that 2-year period their income will have risen sufficiently because they'll become qualified or something else. For us to say to the joint borrower, thanks for your help, we can do it on our own now, and then we release the joint borrower from their undertaking, so they might only be on for a few years before they can be removed.
And that's why I love doing lease option agreements so much. And I did that, as you know, when I got started, because we've known each other now for what, 14, 15 years?
Something like that, yes.
I was a kid, bro. And we met at Business Networking International.
Yes, that's right.
Back in Wolverhampton. But like with a lease option agreement, which is what I did a lot of when I was a teenager, would be a case of, I'll buy the house in 7 years. In the meantime, the mortgage stays in their name. I'm reimbursing them.
Yes.
But then in 7 years, my credit's better. I've rented the house out and I've saved up the rent, so I've got the deposit.
There is another way. It's more with residential than buy-to-let mortgages.
Yeah.
And that's where you can have more than one borrower. For example, you could perhaps have 4 borrowers, so that you have 4 incomes to bring to the table. But perhaps only 2 of those people own the property. The other 2 are just mortgage borrowers. So some lenders will do that for people.
There's always a solution.
Yes.
And I think that's what makes you such a great mortgage broker, is that you are solution based.
Yes.
And a lot aren't though, Andrew. A lot of property professionals, they always find the problem.
If somebody says what they want to do, we tell them how they do it. Even if it looks as if they have no income, or we can tell them how to get through it.
Talk to me then about, how do you sort your credit file out? How do you even know what your credit is, and how do you clean it up?
There's lots of credit agencies, Experian, ClearScore, Equifax, and we all have a right to sign up to one of those organisations so that we can actually view our own credit file if we want to. We recommend people always subscribe to that, to keep an eye on it, not just so that they know what the lender is saying about them, but also in case somebody else is fraudulently using their name to obtain credit, and it happens a lot.
And if your credit is bad, because I've even been on there and I've thought, oh my gosh, that T-Mobile payment of £20 didn't go through 6 months ago, and now it's brought my credit down. How do you clean that up? How do you grow your credit over time?
The great healing process for your credit file is time, unfortunately.
Yeah.
So some lenders say if you've missed a mortgage payment in the last few months, you can't get a mortgage. But if you missed one last year or the year before, so in other words, the greater the elapse of time from the time that the event occurs to the time that you apply for a mortgage is the healing process.
Right.
For
So
you.
Basically, pay your bills on time.
Yes.
If you've got debts, always make sure you're paying the interest.
Yes.
Talk to me about multi-lets, because you know me, with always wanting to rent the rooms out in the house.
Yes.
And there's a difference, isn't there, between like a proper HMO, where you're going to get a HMO mortgage, where you might have like 6 or 7 rooms, en suites.
Yes.
And then if you just wanting to get consent to rent out 3 or 4 rooms. But talk to me about the different mortgage products for this.
If it's an HMO, it has a license, and it has a license because it requires one because of the number of properties.
And that's if there's 5 or more people.
If you want to mortgage and it's already got a license, then that's fine because the lender sees what they're getting. If, however, it's your intention to buy it and make it into a 5-bedroom HMO, then the lender will still assess it as an HMO and still charge you an interest rate based on HMO. But some of them will say, right, before we mortgage it, we've got to see that you have actually made your application to the local authority for the license. However, if it's less than 5 and it's a multi-let, in other words, it doesn't need an HMO license, then there's 2 ways a lender can treat it. Most of them just say, well, we'll regard it as an HMO. It's the same thing because you're renting individual rooms. You're not having one AST, you're having a group of ASTs. However, can you imagine perhaps a student let where there's 3 or 4 students in there and they all sign the same AST? There's only one AST, there aren't 3 or 4 ASTs.
It happens all the time.
Some lenders say, depending upon what our valuer says, we might regard that as a single AST mortgage.
What about if you're doing it as a serviced accommodation and you're renting it out on Airbnb or short stay lets?
There's 2 types nowadays that the lenders will deal with. They'll either call them a holiday let or a serviced accommodation. And quite a lot of the ones that we do are actually holiday accommodation. Holiday lets, basically. So again, there are lenders who do those, whether it's you buy it as a private individual or limited company. There are lenders who do those, but they charge a higher rate of interest.
Why is it important to get the right type of mortgage on the right type on the house? So what would happen if you rented a property out on Airbnb, but you just had a buy-to-let mortgage or a residential mortgage. Let's say you bought it on a residential mortgage and you put down a small deposit of 10%.
Yeah.
You had really cheap rates, and then you rented it out on Airbnb. What could be the consequence of that?
People do it. The potential hazards are that your mortgage lender finds out somehow. And if the mortgage lender finds out, they will say to you, wait a minute, we didn't authorise this for you to use this in this way. If it's a residential, if it's a lender who doesn't do buy-to-let, they're going to insist that you pay the mortgage off, and that will mean you'd have to remortgage.
And they might then blacklist you and not lend to you again.
I've heard of that, but I haven't seen it happen. One thing you have to do is you have to make sure, if you change it from residential or single tenancy, you have to make sure that your insurance company is informed.
Right.
Because if they're not, and there's a problem and there's a fire or something, you could find that you have no cover in force.
Another thing is, as you know, one of the things that we do regularly is we'll buy a house on a bridge.
Yep.
And then once we've refurbed it, we'll then refinance it
Yes.
and get our money back.
Yes.
Is that something that you guys help with? I
Yes,
know
we
you
do it all the time. Couple of things. Some lenders will not refinance a house. In fact, probably more than 50% of lenders will not refinance a house until you've owned it for 6 months.
Yeah, but that's standard though, because the refurb is going to take you a good few months. But people don't realise, Andrew, that there's any lenders that will let you do it sooner than that.
They will let you do it, but the thing you've got to watch is, supposing you bought this property run down for 100,000,
Yeah.
and after 2 months you've made it much better, you've improved it dramatically, so it's now worth 120, 130,000. Some lenders who will refinance it within 6 months will only value it at what you paid for it, even though it's worth more money. They won't value it at full market value. You might persuade them, if you show them what you've done, you might persuade them to tweak it up a little bit.
Yeah.
But you won't generally get the full market
So
value.
generally, you have to expect to wait 6 months.
I think so, because then you've got the full spectrum of lenders to choose
But Andrew,
from.
6 months is not a long time to wait.
No.
And on a bridge, your interest will be very minor. So you'll buy it, you'll refurb it, you'll refinance it after 6 months.
Yes.
You'll get your funds back.
Yes.
And then you're left with effectively a free house.
Yes.
Which is an incredible strategy.
We find commonly people don't allow enough time on the bridging loan.
Correct.
Because they say, it's going to take me 3 months to improve it. Then the bridging loan finishes in 6 months.
Right.
But you can't make the application for the refinance till you've owned it for 6 months.
Yeah.
And then the bridging loan's expired. It's going to take another month or two at least to get the mortgage.
I had this
through.
situation with a couple on our academy. They've just negotiated to buy a house.
Yes.
They need to get planning permission to turn it into flat, then turn it into flats, all the building control that goes with that, the whole caboodle, and they got a bridge for 12 months. And I said, it's a big project. Planning permission alone could take 6. And then by the time you've got all the builders and building control, you are risking cutting it too fine. So I think that's the importance of having good professional advisors. So Andrew, thank you very much for your time.
Thank you very much. Thank you. All the best.